Welcome back to Self Invested, where we talk about how you can do better with money. In this video, we're going to be doing a deep dive into how the Help to Buy equity loan interest rate works, so you can gain a better understanding of how it works, and also I'll be providing tips on how you can make sure you're not paying any more interest than you need to. If you find this video useful, make sure you give it a like, and if you have any comments or questions, make sure you leave them down in the comment section below. As always, all the research material that I use to make these videos can be found down in the description of this video. I'm going to start off this video by giving a quick summary of what the Help to Buy equity loan scheme is. If you're already familiar with the scheme and you don't need to hear this section, then you can skip to the next chapter. But as a quick reminder, the Help to Buy equity loan scheme is a government initiative which offers first-time buyers equity loans of up to 40% in London and 20% in the rest of England to buy new build homes. For the first 5 years after buying your home, there's no interest to pay on the loan. But from year 6, you start paying interest. But those payments that you make are not repayments. They don't go towards paying off your loan. For repaying your loan, there's a completely separate process which is similar to the staircasing process with the shared ownership scheme. If you want to find out more about how to repay the Help to Buy loan, then I talk about it in this video, which you can find a link to above my head, but also down in the description of this video. Now let's take a closer look at how the interest rate works. 5 years and 1 day after buying your home, the interest rate kicks in at 1.75%. The exact amount that you pay is dependent on the market value of your home at the time you purchased it. So if you pay £300,000 for your home and you took out a 20% loan, you would be paying interest on £60,000, which is of course 20% of £300,000. This means the total interest you would pay over a year is 1.75% of £60,000, which is equal to £1,050. Divided over 12 months, this means your monthly payments would be £87.50. Once the interest for the Help to Buy loan kicks in, it increases annually with inflation on the 1st of April. The exact percentage that your interest rate increases by is dependent on whether you bought under the old scheme, which ended in 2021, or the new scheme, which started in 2021. Your interest rate will increase by the retail price index, RPI, plus 1% under the old scheme, or the consumer price index including owner-occupier housing costs, CPIH, plus 2% on the new scheme. RPI and CPIH are both forms of calculating inflation, which is the rates at which prices increase over time. Now, this may sound like the interest rate under the new scheme is going to increase quicker than under the old scheme, but this may not necessarily be the case. This is because RPI tends to be around 1% higher than CPIH. Just as an example, the average RPI rate over the last 20 years is 2.9%, and the average CPIH over this same period is 2.1%, which is a difference of 0.8%, and means if the Help to Buy interest rates were to increase by these averages in the same year, then the interest rate on the old scheme would increase by 2.9 plus 1, which is equal to 3.9%, and the interest rate on the old scheme would increase by 2.1 plus 2, so 4.1%. So the difference between the increases would only be 0.2%, which is fairly small. However, there is one main difference between these two measurements for inflation that is worth covering in this video, and which could impact the difference between these two rates. And this is how these rates calculate the cost of living for people that own the home that they live in. For RPI, it uses house prices and interest rates to calculate this cost. With CPIH, on the other hand, instead of using the value of owner-occupiers' homes and interest rates, it works out what the rental cost of their homes would be and uses this rental equivalent instead. Put simply, RPI uses house prices and mortgage rates to calculate owner-occupier cost, whereas CPIH uses the equivalent rental cost to calculate inflation. Now, what this means in very oversimplified terms is that if house prices and mortgage rates increase relative to rental costs, RPI is likely to be unusually higher than CPIH, and this seems to be happening currently in the UK. If we look at the RPI rate in February 2022, for example, which was 8.2%, this was almost 3% higher than CPIH at 5.5%, when it's only usually 1% more, as we saw earlier. If, on the other hand, house prices fall relative to rental costs, then CPIH is likely to be higher relative to RPI, which was seen in 2009 after the 2008 financial crisis, when CPIH was 2.5% higher than RPI, when RPI is usually higher than CPIH. Now we're going to look at how the Help to Buy interest rate increases year to year. With the example that I'm about to show you, I'm going to use the old model, which increases by RPI plus 1%, because I think it's more relevant to 2022, since the new scheme only started last year in 2021, and the first year that people on the new scheme are going to have to pay interest is going to be 2026 at the earliest. But the principles that I talk about in this section of the video remain the same for both the old scheme and the new scheme. As mentioned earlier, according to the ONS, the latest RPI rate for February 2022 was 8.2%. This means, according to the Retail Price Index as a measure for inflation, prices have increased by 8.2% between February 2021 and February 2022. If this inflation rate was used to calculate the Help to Buy interest rate rise from year 6 to year 7, so from the initial interest rate of 1.75%, it would increase by 9.2%, which is the RPI rate of 8.2% plus 1%. 9.2% of 1.75 is 0.161, which means the Help to Buy interest rate would rise to 1.911 in year 2, which would probably be rounded to the nearest two decimal places, which would be 1.91%. In terms of an actual monthly cost increase, as we saw earlier, a Help to Buy loan of £60,000 at the initial interest rate of 1.75% would equal a yearly cost of £1,050 and a monthly cost of £87.50. If the rate increased to 1.91%, the total yearly cost would be £1,146 and the monthly cost would be £95.50, which would mean an increase of £8 a month, which is a relatively big increase. But I should mention that, as we saw earlier, an RPI rate of 8.2% is unusually high. In the last 20 years, the highest RPI rate was 5.2%, and the average over this period was 2.9%. If you watch the news, I'm sure you're fully aware that we're facing record high inflation rates. It's also worth mentioning that the government's target RPI rate is around 3%. It's likely over the next few years that this inflation rate will lower back down to around the 3% target. But for people whose interest rate will increase this year and possibly over the next few years, they will likely be facing higher than usual increases in their Help to Buy equity loan interest rates. Before we move on, I quickly want to show you how the interest rate for the Help to Buy loan would increase if we fixed the RPI rate at 3% over the full life of the loan. As you can see from this table, with an RPI inflation rate of 3%, the interest rate for the Help to Buy loan doesn't increase that quickly. And comparing this to the cheapest loans I could find on the Money Saving Expert website, which are around 2.7%, it remains relatively low until around year 17. And comparing it to the average mortgage rates available for mortgages with a 75% loan to value rate, the Help to Buy loan is within range of these rates until around year 18. And it's worth mentioning that the current mortgage rates that we are seeing are unusually low based on historical figures, as you can see from this graph. However, this is all based on historic figures, and the future could be very different. This current period that we're experiencing is very different. And if we end up experiencing long periods or many years of high inflation, then the interest rate rises that we see over time will be much higher than the examples that I've shown you. Now, the last thing I want to cover in this video is a piece of research done by the Money Saving Expert website, which found that depending on when you complete the purchase of your home, your interest rate for your Help to Buy loan could increase earlier than you think and could end up costing you thousands more than you realize over the full term of the loan. This is all because of when the interest rate rises, which is different to when you think it may be. As we covered earlier, you start paying interest on your loan 5 years and 1 day after purchasing your home. So if you purchased your home on May 1st, 2017, you would start paying interest from May 1st, 2022, because this is 5 years and 1 day after purchasing your home. You would think in this situation that the interest rate would rise on the anniversary of this date, so the 1st of May 2023. But in fact, it would actually rise on April 1st, 2023, because all interest rate rises happen on the 1st of April the following year, no matter when the purchase of your home was completed. This means the later in the year that you purchase your home, the earlier the interest rate will rise for you. For example, if you completed the purchase of your home on December 31st, 2017, you would start paying the 1.75% interest on your loan from December 31st, 2022, but your interest rate would rise 3 months later on April 1st, 2023. However, if you had completed the purchase of your home a day later, so January 1st, 2018, you would start paying interest from January 1st, 2023, but your interest rate wouldn't rise until the following April, so April 1st, 2024, 15 months later. So that's 12 months longer at a lower interest rate if you purchase your home a day later at the start of the year. So how much more would this actually cost you if you actually completed your purchase on the 31st of December? Well, based on the example that I gave with a £60,000 loan rising by 4% a year, if you bought your home on the 31st of December, you'd end up paying around £31 more than if you'd completed your purchase 1 day later on January 1st. Admittedly, this is not a great deal more by itself, but the Money Saving Expert website looks at the difference over the full term of the loan at different amounts. As you can see, the bigger the loan that you take out, the more that's paid in interest over the term of the loan. And this could end up being thousands more than you realize. For the maximum loan amount of $240,000, for example, over the full term of the loan, the additional cost to somebody who completed on the 31st of December compared to somebody who completed on the 1st of January would be just under £5,000 more. So what can you do about this? Well, the first thing I would say is to try and pay off the loan as quickly as possible so you pay little or no interest at all. The second thing I would say is take out the smallest loan you need so you're not paying any more interest than you need to. But in terms of when you complete the purchase of your home, sometimes there's not much flexibility with this because it depends on the availability of homes and also how flexible the developer that's selling your home is willing to be. But I think the people that have the best opportunity to do something about this are the people who are likely to complete in December. If I was in a position where it looked like I was going to complete in December, I would talk to my solicitor and my mortgage broker or provider to find out what the implications would be about me delaying my purchase until January. If it looked like it would be favourable for me to do so and my solicitor and mortgage advisor thought that it would be a good idea to, then I would strongly consider doing that, and I would look to the developer to see whether they would be willing to delay the purchase of my home until January. And that way you would face a longer period at a lower interest rate. So what are the takeaways from this video? The first takeaway is that for those whose interest rate kicked in before January 1st this year, you're going to be facing a relatively big increase in your interest rate this April. That's because we're facing unusually high inflation. And it's going to take some years, I think, before the inflation rate comes back down to around this normal level, around 3% for RPI and around 2% for CPIH. The second takeaway from this video is that completing the purchase of your home towards the beginning of the year is better than completing the purchase of your home towards the end of the year, because interest rates will come later for you if you complete the purchase of your home towards the beginning of the year. Having said that, if my heart was set on a place, then I wouldn't allow this to be a deal breaker, because year to year, the difference is fairly small, and I would just focus on paying off the loan as quickly as I could. Now that brings us on to the third takeaway from this video, which is that the two biggest factors for how much interest you pay on the Help to Buy loan are how much you borrow and how long you take to pay back the loan. So the best thing you can do is pay back the loan as quickly as you can and take out the smallest loan that you need to purchase your home. Because the bigger the loan you take out, the more interest you pay, and the longer you take to pay it back, the more interest that you'll pay on it. The fourth takeaway is that, in my opinion, the Help to Buy a loan interest rate doesn't rise that quickly. Now, this is very dependent on what the inflation rate is, because if we see many years of high inflation, then the Help to Buy interest rate loan will increase very quickly. But I think if the inflation rate is to calm down over the next few years, then I don't think over the long run, the Help to Buy interest loan will rise very quickly. Now, takeaway number 5, the last takeaway from this video, is that although it may seem as though the interest rate under the new scheme increases more quickly than the interest rate under the old scheme, because the new scheme increases by CPIH plus 2%, whereas the interest rate under the old scheme increases by RPI plus 1%. In reality, there's not likely to be much difference between how much these interest rates rise over the long run, because as we saw, RPI tends to be around 1% higher than CPIH. Now that brings us to the end of this video. I hope you found it useful. If you did, then please give this video a like. And if you want to watch other videos that I've done about the Help to Buy scheme, then I'll provide a link to a playlist where I explain many other aspects about the scheme. I'll provide that link now on the screen and also down in the description. Anyway, thank you for watching, and I'll see you in the next one. Take care. Bye.